They're about there because I'm with him.
Okay.
Tim and I talked about the dollar about a year ago on the show. And literally nobody on the planet thought that the dollar was going to be weak because our interest rates were going up. Europe was engaged in quantitative easing, buying corporate debt. It's not about rates. It's about global growth. The only periods, which we've talked about on the show before, that you've had actual dollar appreciation that's significant and sustainable is when you have global economic deceleration. It's opposite day. We have a synchronized global recovery. We have a weak dollar, and we have a reacceleration in the U.S. with the hurricane aside. That is, the headwinds have become tailwinds, yet I've not seen many people up their targets for earnings, up their targets for margins, or up their targets for S&P.
Okay.
So once we get through a little corrective period here, I think that is the investment. I think I'm too low for next year.
So which is the sector that will see the most upward revisions because of a weak dollar?
Technology should be, because they have most of their, it's the sector with the most sales overseas. That, I believe, is reflected to some degree, so I'm neutral in technology. And I continue to say if you were way overweight technology, I would pare it back a little bit. And I've been so ridiculously wrong on the banks over the last month and a half, but I think that's where you go. Listen, I was on the phone with a great portfolio manager today. We're trying to figure out why the bond yield is where it is. And, you know, I'm going to break the cardinal rule of television and say, I don't know. Like, you have a bond market where the fundamentals are saying the opposite to me. The hurricanes are actually an inflationary move. Go ahead and try and buy some materials to build a house. That's going to be an interesting one. How about the labor without immigration to go and build the house?
Right.
So you've got a real situation of economic stimulus domestically. International scene is still better. The PMIs are good. Here's an interesting thing, guys. For the first time this cycle, I can find all the capital spending surveys are at cycle highs or historic highs. The NFIB capital expenditure survey, the Philly Fed capital. What if we have an okay consumer, good consumer, because the median incomes are going up, and you actually have capital spending and global growth? So that's why I think what Tim said is perfect. It's the growth story that gets it to go up.
Have you been along these tech companies, pare back?
What
about energy?
But I want to be really clear, Steve.
People have been underweight.
I pick them up. And that's been wrong. I've been good at being wrong lately.
We've all been holding our breath waiting for, but most people have gone broke looking at it. That inverse correlation seems to be on again, off again, and that's not investable.
Well, I have the Steve, what I've been looking at is the pro-growth versus the slow growth trade. The slow growth trade is technology, because you know there's growth in technology. So if you want growth, you have to go there. The slow growth trade is bond surrogate. As Guy said earlier, you know, utilities, telecom, staples, anything with a yield is jumping up. Right? If you look at the last six months or so, you've been bottoming out that relative ratio of the pro-growth, which is financials, industrials, materials, energy. I'm not saying it's way outperforming. It's not. But it looks to me like that relative performance is bottoming from a tactical level. And I got to say, I'm baffled on why yields are here, other than the perception that we're going to have so much debt like we don't already somehow.
But overall, you like financials here, you would pick up energy here.
I've been wrong on finance. So here's in order. It's been financials, industrials, materials, especially, actually I'd split materials and industrials, and to a lesser degree energy.
All right, Tony, great to see you. Tony Dwyer,
Thank you, Mel.
Genuity. How do you like what Tony likes?
I love Tony Dwyer.
But how about the sectors that he likes?
I think
separate questions.
No, well, listen, financials, there are many reasons. My reason has been valuation. You've asked the question, what's the reason on them? The reason is valuation. But in terms of energy, we had Rich Ross here yesterday, and he talked about ExxonMobil maybe being a one-day event. I think my pushback would be, there's a good chance that Exxon might have bottomed out for the short period of time yesterday. Look at the performance yesterday on volume. Look at it today. So I think if you want to be somewhere, finally, maybe XOM will get you done.
And in Carter's appearance the other day, Carter Braxton Worth, he's also in the top 3 of guests.
So is Tony Dwyer.
The numbers don't add up, Josh. Sometimes the numbers don't add up.
There are 12 people who are in the top 3 guests of all time on Fast Money. But aside from that, Carter came here and made a very compelling case against industrials, which is one of the sectors Tony likes. Where do you stand on that?
Well, on industrials, if you think about some of the core players in there, either you've got a Boeing or you've got
defense names.
You've had names that have had massive runs, and then you've got maybe slightly broken stories in whether it's some of the autos, whether it's some of the machine operators. But when you think about what's going on right now, again, think about the places where you're getting growth and where you have reflation. And I talk about emerging markets a lot, but the last 2 days, again, EM's outperformed the S&P by 100 basis points. Brazil cut rates 100 basis points today. Brazil's been blowing the cover off the ball. If you've been in any of these trades, and a lot of this is a resource trade, a lot of this is a global trade, and I think you should look at them both.